And hello, my colleagues. I hope everyone is well on this 30th of December. We're almost done with this crazy year of 2020. Glad it's almost over. What a wild year. Anyway, it's 5:35 in the morning, and what I want to do is I want to pick up on chapter 11 here where we find the initial investment, okay? We're talking about cash flows, right, from chapter 11. So the term initial investment, as used here, refers to the relevant upfront net cash flow that managers should consider when evaluating an investment opportunity. So when you go to college, right, you're making an investment in your future. You pay tuition, right? That's your upfront initial investment, right? Right. So just want a good example, right? So our discussion of capital budgeting will focus on projects with initial investments that occur at time zero. And this is an important idea, right? Time zero. So you'll see that on the timeline. All right. So we can see here, okay, where the initial investment occurs. And basically, you take all you net all of the incremental cash flows at time zero that you shelled out, subtract all the cash outflows at time zero from all the cash inflows. Okay, so you net everything together. You may have positive things, right? You may have sold some stuff in the intervening time. All right, so let's look at table one here, and they talk about table one. Here's your installed cost of the new asset, right? Your cost of the asset and the installation costs, right? You got to include the installation costs. Don't forget. And here's where you sold the old asset. Maybe you had something like as I just mentioned. So you're changing the net working capital for and that's what it's called, net working capital, when you subtract two from one. Okay, everyone see that? Let's just be clear. That's called change in net working capital. All right, so I wanted to make that point clear. All right, so the installed cost of a new asset, you add, and again, you can just go through this and it tells you, and they include installation costs. And this is an important concept called depreciation. And it comes around to the IRS requiring you to depreciate things as they age. Now, depreciation is the writing down of items like assets as they age. So if you spent 20 grand on a computer or a fancy computer or something like that, or a machine, you can, excuse me, you can write it down over years, and they have tables of how much it's salvageable after so many years. And here's where you have the after tax proceeds from the sale of the old asset. All right, so the tax basically you're going to pay on the sale of the old asset depends on the relationship between the asset sale price and its book value and the existing government rules. So if you sell something, you may have to pay tax depending on its book value, if it hasn't been fully depreciated. All right. All right. So the book value of an asset is the asset's value on the firm's balance sheet as determined by accounting principles, right? So an asset's book value is usually the difference between what the asset cost and the accumulated, and here's where I said, and the accumulated depreciation. All right. So depreciation is a very, very important concept. Things age, right? So here's the simple equation 11.1 on depreciation, right? All right. So here's an example of from 11.2 on depreciation, and you can see their reference table of 4.2 from chapter 4 on and you should go back and review depreciation, and they show you here how they depreciate everything. And you originally paid $100,000 for with installation, okay? So you originally paid for that, And finally they say the book value here is the installed cost minus the depreciation, which they calculated above, right? Let me go like that here. Let's see if I can get that go. All right. Right. Here's the depreciation. And that's accumulated after 2 years. All right. All right. So, all right. So, you basically have these different tax treatments. And this is an important concept here, depending on how you sell an asset and what its current book value is worth. All right. So this is important that you read this. Okay. This is a very important item. All right. So this table is in regard to what they're talking about here, and they show you that if you sell an asset and there's a gain on the sale of an asset, and if it was greater than the book value, you tax it as ordinary income, and they give you a 21% tax rate. Be careful with these tax percentages because tax laws change, and as these books age, they're out of date with regard to the tax laws. Okay, I just want to let you know. So they use 21%. All right. So anyway, just go through these. And all right, so I want to spend a lot of time talking about this example 11.3, and I will do it because there's a lot with regards to that, as you can see. But what I'm going to do is first I'm going to play this video for you. We'll do this video first, and then in the next installment, I will talk about this example, okay? Because it's probably the same thing. So let's play this video here.
In many investments, a company acquires new equipment and disposes of old equipment. Sometimes that old equipment is simply scrapped, but often companies can resell their old equipment in a secondary market. The tax consequences from selling an asset depend on the relative difference between its sale price and current book value. When the sale price is greater than the current book value, the difference is a taxable gain. If instead the sale price is less than the current book value, then the difference is a tax-deductible loss. When the sale price is equal to the current book value, there is no tax consequence because the company selling the asset is neither making a gain nor taking a loss. The first step to determine the tax consequences for the sale of an asset is to find the asset's current book value so that it can be compared to the sale price. Hudson Industries purchased an asset 2 years ago for $100,000. Since purchasing the asset, Hudson has taken depreciation deductions totaling $52,000. So the asset's current book value is $48,000. With the current book value in hand, you can now determine the tax consequences and after-tax proceeds for whatever sale price Hudson can obtain for its asset. For example, suppose Hudson sells its old equipment for $110,000. Since the book value is just $48,000, Hudson earns a total gain from the sale of the asset of $62,000. This total gain is comprised of two parts, a capital gain and recaptured depreciation. The capital gain is the portion of the sale price above the original purchase price of the asset, and the remainder of the total gain is the recaptured depreciation, which is the difference between the original purchase price and the current book value. For Hudson, the capital gain is $10,000, which is the $110,000 sale price minus the $100,000 initial purchase price. The recaptured depreciation is then $52,000, which is the $100,000 initial purchase price less the current book value of $48,000. When a company sells an asset for more than its current book value, then the total gain is taxable as ordinary income. If Hudson's tax rate is 21%, then it will have to pay $13,020 in taxes on the $62,000 gain from the sale of its asset. In this case, the tax consequence is a tax liability. which can be subtracted from the sale price of the asset to arrive at the after-tax proceeds. If Hudson sells the asset for $110,000 and has to pay $13,020 in taxes, then the after-tax proceeds from the sale of the asset are $96,980. What if instead of selling the old asset for $110,000, Hudson Industries sells the asset for $48,000? Well, in this case, there is no gain on the sale of the asset since the sale price is the same as the current book value. And when these two values are the same, there is no tax consequence. So in this case, the after-tax proceeds from the sale of the asset will simply be the sale price of $48,000. In many cases, used assets do not have a great deal of value, and companies often sell them at a loss. If Hudson sells its old asset for $30,000, that's $18,000 below the current book value, so Hudson experiences a loss on the sale. Typically, Hudson would be able to use this $18,000 loss as a deduction to offset other income in the business, and in doing so, reduce its taxes by 21% of the loss, or $3,780. On a net basis, selling the asset for $30,000 results in an after-tax proceeds of $33,780.
All right, so that's that example. And as I said, I will pick up example 11.3 right here. Okay, we'll go through that. All right, everybody, Happy New Year. Be safe.